Good.
Because what's that?
Can you hear me loud and clear, brother? All right, all right. What's going on, everybody? Hope everyone's having a good night so far. Do me a favor, type 555 if you can hear me loud and clear. Just want to make sure the sound is good on your end. 555 if everything is all good and clear. All right, before we begin, and also tell me where you're opting in from. What city, what town, what state, what country, what part of the world you are at. Type it in the chat right now. I think I got muted. Can you hear me now? 555,
Yes,
y'all can hear
sir.
me.
Yes, sir. You the host, Nes. Nobody else can talk to. I set it up like that from the roof for you, right?
Perfect, perfect, perfect. All right, so could people type in this chat or not?
Yeah, they could type. They could type in the
All
chat.
right, y'all, listen, I'm gonna need y'all to give me some energy over here. Type 555 in the chat if you're ready for some value. If you're ready for some good value, y'all, listen, I'm not here to waste your time. You know what I'm saying? And I think what I have today is something I think you're really gonna appreciate. So I hope y'all ready. I hope y'all ready to learn because at the end of the day, here's the bottom line, right? We know that the forex market is a decentralized market. In other words, it's one big game of tug of war. Where you could have a million retail traders worldwide, right? And we could get in the same positions at the same damn time. But it ain't nothing compared to the volumes that the big banks are bringing in, and that's what's really going to move the market. So it's really a big game of tug of war, y'all. So listen, get ready to learn. Like Rob said, we're about to get started in about 2 minutes.
Hey, Nes, do me a favor. Turn on your camera. Your camera's off.
All
There you
right, we
go. So
good?
you can see your beautiful face, dog.
Stop. Crazy, man. Well, I'm excited. I hope y'all are excited. You know, it's not every day that we can be able to trade alongside people that we actually like. I tell you, when you meet some of these cats, behind the scenes, it's really pushing buttons in these major financial institutions. A lot of them are people you're probably not gonna like, to be honest with you. A lot of OGs, a lot of straight shooters, people on the trading floor back in the days, Wall Street, 1980s, that kind of crowd, it's pretty rough, you know what I mean? So in this day and age, we have so much information and access that we could tap into all that and then some. The concept is bringing Wall Street to all streets, bringing the concept of Wall Street to all streets. And so that's what I hope to bring to you tonight. And I hope we have a good time. Rob, so you said we're gonna get started in a couple of minutes. I don't know when you want me to start. I'm just kind of filling in the gap over here, right? Okay. So he's doing something over there. So in the meantime, y'all, tell me what city, what town y'all coming from. Let me know what part of the world you are chiming in from. I know sometimes in some of my calls we have people from other countries and all that. All right, so we got MIA in the building. Okay, we got ATL. We got Buffalo, New York. Let's get it. Charlotte. We got Miami as well. Tennessee. MIA. Vegas, Hawaii, Venezuela, Orlando, Florida, Montreal, Philippines, Tennessee again, North Dakota, Kansas City, Jersey. All right, Massachusetts, let's go. Tennessee, Penn State, New York, Barbados. Oh, I know you living good. I know you good over there in Barbados. New Zealand, Dade County. Okay, okay, we got South Florida in the building over here. I respect it. All right, we have H Town. What's good, Houston? It's crazy. I was looking into some houses about 20 minutes, away from H Town, so in the outskirts. All right, we got Ocala, Florida. Let's go. Toronto. Sheesh. We got Toronto in the building. Minneapolis. Santiago, Dominican Republic. Yes, yes. Two out of my three sons are half Dominican. They got a lot of family in Santiago. Texas, Reading, PA. Let's go. Let's go. I got some family around Reading, Lancaster area, around that area. All right, we got United Kingdom. Let's get it. Bro, I live 20 minutes from Houston. It's nice out here. Y'all, what? I tell you, the dollar, the power of the dollar is strong in Texas. We got Louisiana. Louisiana. I know there's a lot of talk in Louisiana right now. The Super Bowl is going down in New Orleans. I know that. Nico, let's get this knowledge. Yes. Johnny RPG, Orlando. Yes, that's where I'm at right now. I'm in the O. Start whenever you're ready. I can't unmute myself. Is that to me? That's you? To me? All right. All right, cool. So I'm gonna share my screen, ladies and gentlemen. So look, we're gonna do a little bit of both. We're gonna get into slides first, right? Because it's important that instead of us just talking, right, that I provide some kind of visuals for y'all. I think that's really, really important, especially for information retention. So I do want y'all to take notes, okay? So everything that I'm going to be going over, everything I'm going to be teaching you was taught to me, okay? Everything I'm teaching you was taught to me, but I'm not just anyone, all right? I've been trading for over 10 years, all right? Started out with stocks and stock options, and then later that summer in 2015, we started to get into Forex. Now, I loved it because Forex, right, is obviously a worldwide thing. We're not just dealing with people who can trade in New York Stock Exchange, for example. We're dealing with people worldwide that can trade currencies from all around the world. So it was a real beautiful thing back in 2015. I'm approaching 10 years. I'm approaching 10 years with trading. And so a lot of the things that I'm going to show you guys is stuff that you really should understand. I know you guys have a degree of information on it. Perhaps I could bring just a little bit more, maybe something a little more visual for you. Okay, so I'm going to share my screen. All right, and here we go. All right, so quick question. If y'all can see my screen, right, do me a favor and type 3D3 in the chat. I want to make sure that everyone is able to see this and we're all good. All right, so what I'm going to do is I'm going to first get through the information, okay? And then in the end, we'll get into some questions and things like that. Robert says I got 30 minutes, so I'm going to try to make this the best 30 minutes of your life. Trading wise, all right. Pause. So let's get right to it. Okay. So obviously some of you know smart money concepts, but some of you are probably not too familiar with the terminology of ICT, which is inner circle trading. It's basically all within the same family, right? But I hope I can clear up a lot of the stuff, especially for all of you that are just learning right now. So smart money concepts trading is a strategy used primarily in the Forex market and other financial markets that revolves around understanding and following the actions of large institutional players, often referred to as smart money. The strategy involves identifying market manipulation, liquidity grabs, and understanding the structure of the market to anticipate potential moves, okay? So this is what typical market structure looks like. Some of you know this, some of you don't know this, but I'm assuming that there's a good percentage of people that probably don't know this stuff, right? Because if you did, you'll be, a lot of you will be in the millions by now, right? So a typical market structure, you got you're in the downtrend, you have your lower lows, lower highs. In the uptrend, you have your higher highs and higher lows, right? You have breaks of structure that usually occur, right, when the market is breaking into a new level, right? But once the market starts reversing, that's a change of character, right? So some individuals that I speak to that are like solely ICT, inner circle trading, they use different types of terminology. So I'm gonna bring it both together because I think it's very important. So this class that I'm giving, I think you guys really like it. So order blocks, all right? The different types of order blocks that exist. Order blocks are areas on the chart where institutional traders, banks, hedge funds, etc. place large buy and sell orders. There are often origins of significant price movements and can serve as strong support or resistance levels. There are bullish and bearish order blocks. Bullish order blocks are formed before a strong upward move, while bearish order blocks are formed before a strong downward move, right? So I already chose an example earlier today on the charts that we're going to take a look at a little later. Liquidity concepts. Liquidity is a crucial aspect of SMC trading. Institutional players often create false breakouts or fake outs, depending on how you talk, also called stop hunts or liquidity grabs, to trap retail traders and collect their stop losses at liquidity. Key areas to watch for liquidity grabs include previous highs and lows, trend lines, and round numbers. Okay, that's huge. Round numbers is huge. Understanding where liquidity is pooled can help anticipate where smart money might drive the market next. Okay, imbalance. Okay, so here's one of those things where between ICT and SMC, it's different terminologies, but it means the same thing. So they're synonyms, right? So imbalance, right, which is basically fair value gaps. Imbalance, also known as a fair value gap, occurs when there is an inefficient price move, creating a gap between consecutive candles. This often gets filled as price seeks a more balanced state. These gaps often filled by the market, and they serve as potential areas for entry or targets for exits. Okay, so you have your valid fair value gaps, your invalid ones, and you have to be able to tell the two. All right, you have to be able to discern that. So here's a visual that helps you discern that. Okay, so understand that when we're talking about this stuff, right over here, you can see that this is a legit fair value gap. Okay, notice this is a bearish candle right over here, okay, and here's a strong upward move, and right over here, okay, you have a valid gap. Now it'll be a little different if this right here wouldn't be a valid, wouldn't be the start. The top of the wick over here wouldn't be the start of a valid fair value gap, right? It would be this one, all right, the one right before it. It has to be the candle that's going in the opposite direction before that strong impulse move to the upside in this case, right? So in other words, this right here will make it a valid fair value gap right over here. So there's certain things to look out for in the market. Mitigation refers to the process where institutions close out their positions at a loss or break even. The market often revisits previous order blocks or areas of imbalance to mitigate these positions. Okay, so some of you already know this stuff, some of you don't. Traders look for entries at these mitigation points, expecting continuation of the trend after the price revisits these levels. Okay, entries and exits. Entry strategies. Entries are often based on a confluence of factors. Confluence meaning like, okay, there's a lot of indications that the market is moving in a certain direction. Okay, a confluence of factors such as liquidity grabs, order block zones, and confirmations of market structure breaks. Traders look for lower time frame confirmations to minimize risk. Stop losses, all right, stops are usually placed just above or below the order block or liquidity zone to avoid getting stopped out by minor moves. Take profit. Profit targets are generally placed at opposing liquidity zones, previous highs, lows, or areas of imbalance, right? Time frames, okay? So when you're looking at the charts, right, if you're looking at a 1 minute chart, 5 minute chart, 15-minute chart, it's not really telling you the full story, okay? Remember this, the higher the time frame, the stronger the confirmations, okay? The stronger the confirmations. So smart money, SMC traders, okay, use multiple time frames to gain a better perspective on the market. When you view multiple time frames, you have an advantage. Believe it or not, people just don't do that. You know, believe it or not, some people treat trading like gambling, okay? Gambling is leaving things up to chance, while trading, all right, it requires calculated risk. Higher time frames like the daily or the 4-hour charts are used to understand the overall trend, while lower time frames like 1 hour, 15-minute, 5-minute charts are used for precision entries. So use the lower time frames for your entries, okay? Risk management to me is more important than accuracy, right? Because let's say if you have the right risk management, right? And out of 10 trades, let's say you lost like 7 out of those 10 trades, right? But 3 of them were hits. Because of how you have your risk management set up, you can still be up. Okay, so for example, if you're setting your risk rewards at like a 5-to-1 risk reward ratio, 10-to-1 risk reward ratio, which is a little more extreme, 3-to-1 risk reward ratio, then you can do the math as to how accuracy can, it can be a factor of negatively impacting your trade, but really risk management is going to do it. So proper risk management is vital. is super vital. 9, psychology and discipline, right? SMC trading requires a disciplined approach to stick to the plan and not be swayed by emotions. It involves waiting for high probability setups and not chasing the market, okay? Don't chase the money, right? Trade the setup, okay? Don't try to chase the market, but trade the setup. It's like laying bear traps, right? You have to have the conditions, the ideal conditions in order for you to strike your entry, okay? So there's some key terminologies, all right? We have the breaker block. Breaker block is a failed order block that gets invalidated when the market moves against it. After the price breaks through the breaker block, this area can then serve as a new level of support or resistance. Breaker blocks are often used for entry points after a break of structure. Liquidity pools. These are areas where retail traders place their stop losses or pending orders. Liquidity pools usually form around the obvious highs and lows or round numbers. This is critical because when most people are just beginning their journey as a trader, one of the first things they learn is what? SRTs, support, resistance, trend lines. So a lot of traders are thinking with the same mentality, and the big financial institutions are taking full advantage of that. Like, they're not sorry. They're taking full advantage of that. Institutions target these pools to induce volatility and grab liquidity before moving in the desired direction. Inducement. Inducement is the process of tricking retail traders into taking trades by creating a false sense of a trend or breakout. It is often followed by a liquidity grab and a reversal where smart money takes advantage of retail mistakes, okay? A lot of times when I notice, right, the market basically violating retail traders, yeah, it occurs during, several parts of the day, during several sessions, but you'll see it a lot, especially with high impact news. You see it a lot, right? So you're going to see the fake breakouts followed by the correction of the market. You're going to see a lot of that. So there's a lot of inducement. Equilibrium price. This is the midpoint or 50% level of a trading range, okay, or a specific price swing. Many SMC traders use the Fibonacci tool to identify the 50% level as a potential area for price reaction. It is often considered the fair value price for an asset, right? So if you look at this, you would notice there's a lot of this going on in the market. Okay, you have your accumulation, and then you have manipulation, followed by distribution. Okay, and inducement plays a factor in this, as you can see in the visual over here. Market cycle phases. Understanding the different phases of the market cycle, accumulation, manipulation, distribution is key in SMC trading. Accumulation is where institutions are building positions. Manipulation is where they trap traders, and distribution is where they offload positions. Again, they are not sorry, right? This is the game of money. It's straight cutthroat. It is what it is. Remember the saying, no friends at Wall Street. There are no friends in Wall Street. There are no friends, really, in this kind of game, really, right? So chalk. So this is another terminology that comes from inner circle trading, ICT, right? That you don't really hear much on the SMC side, which is basically, the same thing, right? So chalk is better known today with new traders as change of character. Again, it's basically a change in the direction of the market. The change of character is a point where the market shows signs of reversing by breaking a series of previous highs or lows, indicating a potential shift in market structure. This is a key sign for many SFC traders to start looking for potential levels. Premium discount zones. In the context of a range or price swing, the premium zone is the upper half above the 50% mark where the price is considered overvalued. The discount zone is the lower half where the price is considered undervalued. These zones are used to gauge potential areas of buying or selling. Okay, so here's some of the terminology synonyms, and I recommend y'all take a snapshot of this right now, right? Because when you're dealing with institutional traders, again, there's two factions, ICT, SMC, but still the same family, okay? So order block is basically the same. Fair value gap is known as imbalance, okay? Break of structure is the same. Change of character, market structure shift, okay? So when you see the terminology use MSS, that's basically a change of character, right? That means a market structure shift. Liquidity void, just imbalance. Stop punt, liquidity grab. Mitigation block, it's the same. Institutional order flow, smart money flow, okay? Right over here. Optimal trade entry. You hear this a lot in ICT. It drives me crazy. Premium discount levels. Judas swing. Manipulation move, right? Liquidity pool. Same thing. Market maker buy sell model, all right? Wyckoff accumulation distribution. Which, by the way, there's there's a lot of debate between who's the true founder of SMC and ICT and all that good stuff. Weekly opening gap is the same as the New York opening gap. Okay, power of three. Remember what we spoke about? This is what Wyckoff figured out, right? The power of three: accumulation, manipulation, and distribution. Okay. Now over here in SMC, you might hear it as AMD, right? Daily bias, market bias, volume imbalance, just straight up imbalance. Okay. So liquidity, once again. When smart money wants to buy a currency pair, they will need sellers in the market. Remember, this is all about supply and demand. The institutional traders come in and they take advantage of this by manipulating, all right, the supply and demand, the supply and demand structures of the market. So when smart money wants to buy a currency pair, then we need sellers in the market. The existing facility to place these positions is called liquidity. Remember this. With every winner in Forex, okay, in stocks and all this other stuff, with every winner on the other side, there is a loser, okay? So let me give you an example, right? Let's say you enter to buy in regular Forex, right? You enter to buy in regular Forex. When that buy hits your take profit, right, behind the scenes, like behind everything, behind the freaking matrix of the market, you basically sold your position to another buyer or another seller, etc. Right? So basically, you're doing the exact opposite when you take profit. So when you buy, you're selling at the take profit. All right? When you sell, you're buying. And so on and so forth. So you're basically you're buying liquidity at a certain level. All right, and then you're selling it off. That's basically what it is. In its pure form. Okay, behind the matrix of the stuff. Liquidity is essentially determined by the placement of stop losses, where stop losses are positioned. Liquidity is found. So it's not just stop losses; it's also where a bunch of people are placing their pending orders. I'm just gonna say this: we're in an election year. The markets is gonna be retarded. The markets are gonna be retarded. I know because I traded in the last two elections. 2016 was like I was like in year one, right? And I was able to score like about 1,000 pips, and I barely knew what I was doing. At least I wasn't as good as I was today, and I was still able to eat from both sides of the spectrum. So it's gonna be nuts. The liquidity in the market's gonna be insane. Institutions are gonna take full advantage of that. All right, so in the market, you have equal high and lows. So these are signs that there is liquidity that is sitting in there. In this case, you see a bullish scenario right over here. So when smart money wants to buy a currency pair, they would need sellers in the market. The existing facility to place these positions is called liquidity, so on and so forth. I already went through this. So question, what does this signify in terms of price action? Okay, so this is what most people do. I want y'all to see this, right? Because I want y'all to be different. Listen, I'm the first one to tell you that there's room for everybody to eat in the market, right? So nobody should be withholding information really, because what's the purpose of it, right? Like, there's no way you're going to be able to snag the entire Forex market in your grasp. No way. It's a $6.6 trillion a day market, right? And it's growing, especially with inflation. They're going to call it $8 trillion a day market at some point, especially with, inflation on USD. But this is what most people are doing, right? They're waiting to buy right over here, okay? But here's the deal, right? Smart money traders, they already see where the order block is. They're going to take advantage of this, right? They're going to wait until everyone gets stop hunted, the pending orders are hit, and it's going the opposite direction. It's going in for the liquidity grab before it continues to the upside. So this is what we're waiting for. But remember what we said, right? The great three: accumulation, manipulation, and distribution, right? So when you are trading a market, I want you to anticipate the manipulation first before you get in. All right, that's what I want you to do. Okay, and here's how it looks like on the bearish scenario side. Okay, so this is what most people are gonna do, right? They're gonna, oh look, there's a a double top forming or a triple top, whatever the case may be, right? So they're gonna be expected to sell right at this level. They're gonna be expected to sell, all right, at this level. Well, guess what? Smart money traders are gonna wait for the liquidity sweep, and then they're gonna go in right after. Okay, so you see this time and time again. And one zone, as you know, sometimes support becomes resistance, resistance becomes support, supply and demand, it's all the same stuff. So basically, there's liquidity sitting at this level right over here, okay? And again, people are going to be anticipating these moves, okay? But for those of you that are trained with the eye, right, you're going to be able to determine, all right, where, how the structure is really looking from the eyes of the bank, the eyes of institutions. So, question: where can be a point of interest to enter the market as a smart money trader? Well, all right. Once you have the eye of a smart money trader, you are anticipating some of these moves, right? And you're learning from that. You can also use Fibonacci retracement to determine where is that 50% zone as well. You're gonna see how this is really playing out. Let these things happen, right? Check this out. Here's some mitigation right over here. Take advantage of this stuff. Trading is all about the future, and the nature of the future is unpredictable, okay? It truly is, all right? Because who knows what's going to happen in the market. And in this case, right, normally someone would categorize this as a change of character. But it's not really a change of direction because, the institutions are coming in for a liquidity grab, right? So this makes it invalid, okay? So combine the market structure concepts with liquidity. Right? Again, here's how an uptrend would look like. You got your low, your high, higher low, so on and so forth, right? And you can see where these, order blocks can be formed. And then you can see that it's truly a trend based on the breaks of structure that's going down. Okay, now obviously if it hits this point and it starts reversing, that would be a change of character. In a bullish scenario, the lowest point between the two consecutive highs is identified as a swing low. All right, so look, you have two consecutive highs, all right, higher highs, two consecutive higher highs, right? And this green dotted line represents a break of structure, right? Here's the swing low right over here, all right? And you're gonna see the same thing again, in a strong uptrend, okay? So when can we confidently say that a change of character will reverse the trend? Okay, well, obviously when you're looking at this, right, from a 4-hour standpoint, okay, you're getting an overview, right? But when you look at the lower time frames, you're gonna see sometimes it's a little different. It's kind of like when you're looking for divergence on the MACD, right? When you're looking at indicators on the main window and you're looking at the MACD, you're kind of waiting for that divergence. It's kind of similar when you look from the higher time frames on down. When you start to see some bends occur in the lower time frame, all right, you're gonna start to notice some things. So in a perfect scenario, okay, higher high, higher low, perfect scenario, okay? Imperfect scenario, which is most likely gonna happen because nothing really happens according to the textbook. You just kind of, you gotta learn this stuff, but at the same time get some real world experience so you can know how really impulsive, the market is. So look, here's a higher high, higher low, higher high, higher low, higher high, lower low, right? Higher low, so on and so forth. You're gonna see more of an imperfect scenario on a lower time frame as compared to a 4-hour, right? So you're gonna notice this stuff. Most traders are gonna do this. They're gonna look at it as like, oh my God, the market is gonna start reversing and stuff like that. But in all reality, you don't want to bet against what the higher time frame is telling you. Remember what I said earlier: the higher the time frame, the stronger the confirmation. So the best trade areas are where the lower time frame and higher time frame trends are in the same direction. Truly, right? So in one time frame, you're gonna have a structure similar to this. In a lower time frame, it may look a little different. In a 5-minute chart, for example, it may look a little different than that. There are some cases where the liquidity concept weakens the strength of the market structure levels. Okay, so here you go. You have another bullish scenario: higher high, higher low, higher high, right? And here's here's what would be change of character. Okay, here's the fair value gap. See it right over here. Okay, invalid change of character because the market did not change directions. It did not just change the trend on you. Okay, so a couple of things that you should definitely check on your checklist. All right, the recent schematic. All right, The fair value gap, liquidity, supply and demand, trading setup, risk management, etc. Okay, there's liquidity that is, is showing itself all in the market. These are where a lot of the people are buying and even placing pending orders, putting their stop losses here, some points, so on and so forth. There's a lot of liquidity in the market, right? You got to be on top of that. Also, another thing to watch out for, right? If you have, let's say, an order block kind of directly under another order block, separated by a fair value gap, you got to be careful. Because remember, the market could be ruthless, right? So before placing any trade, you should look at the left to see what you have to avoid, all right, to see how you could avoid this unnecessary risk. When this pattern is formed and we have a gap and another valid order block precisely under the first one, we don't consider this break a valid change of character. It's a liquidity grab, right? So supply and demand in SMC, okay? So this is the concept of supply and demand, right? Rally-based rally or rally-based drop or whatever. Like, you're going to see some of the same things. And I know we were talking about, how to literally identify liquidity pools that's under these levels, under these supply and demand levels, which is essentially support and resistance, right? It is what it is. So how much traders and investors want to buy a currency, that determines the price of the market and what's happening. The supply is the amount of currency available for trading, all right? So when people buy it, it's exchanged. Supply, obviously, you're able to grab that. Now, when you see that demand is up, right, and the supply is not really there, the price goes up, right? Think of a couple of years ago when everybody was reselling Jordans, when everybody was reselling kicks. The demand was high, but Nike didn't have that supply at the time. I mean, now they did something about the reselling stuff, but the demand was high, supply wasn't there, so the price went up. Oh, you didn't get it? Ah, man, you didn't get those kicks. Well, my boy got them, and you got to pay for the markup, right? That's just how it is. This is how it is in real life, right? So it's all supply and demand, and there's a lot of liquidity behind this stuff. So demand is high and the supply is there, then the price will drop, right? Because the idea is to get rid of the supply as much as possible, meet the demand, and so it's easily available, so price drops. When something is in high demand and it's not really available, it's going to drive the price up. This is the concept of what designers do, like Fendi, Gucci, Prada, etc. They come out with the spring collection. They come out with a fall collection of 2024, right? And so this is never going to be sold again, right? And so it's constant FOMO, fear of missing out, right? They understood supply and demand at such a beautiful level, right? And people buy it because they are literally afraid they're not going to get their hands on this again. Oh, there's 2 jackets in the world like this. Get it today. Then you drop it $6,000. That's something I did with a Louis V jacket, right? So, it's that kind of mindset of supply and demand and scarcity of items or whatever, which drives the price up, so on and so forth, right? Same kind of thing. Supply and demand is everywhere, all right? Wherever there's business occurring, there's supply and demand. So, when the buy order is executed, someone must be willing to sell on the other side. This is literally what I was just talking about, right? And so what you're going to see is the buyers and the sellers, they basically control what's really in supply and demand. That's really what they're doing. They're what they do is impacts the market. It's kind of like how the community is who really drives the price or plunge the price of Bitcoin, for example, right? Same concept, right? Behind the ever-changing price of any currency pair, all right, there's millions of orders between individual retail traders like us, right, and the financial institutions. This is what creates that supply and demand. So market harmony is basically when the order flow is coming in from these millions of orders, okay? When you have, basically this creates unique order flow in the market, and a couple of things to determine order flow. Number 1, detecting the actions of financial institution. Number 2, decoding strategies. Number 3, predicting price future movement. All right, supply, demand, liquidity. The market seeks to balance supply and demand by moving towards liquidity areas in a continuous cycle. This will never end. Institutions cannot hide their order flow or the significant imbalances they create in the market. By recognizing institutional footprints on the chart, traders can align their trades with the direction of the money flow, avoiding market risk and potential liquidation, identifying supply and demand zones. Okay, so here's a scenario, a bullish scenario. Price is ranging right over here, but when we talk about price ranging, right, this is base, right? Because now we're talking supply and demand. This is where the market is gathering more momentum. Okay, this is where the market is trying to find some balance. Okay, so this is base over here. Okay, and then unusual increase of buying pressure. This is rally. So rally, base rally in this example. Okay, this is supply is low and the demand is high, so the price, all right, is increasing. Okay, now in this example right here, all right, this is the base. Okay, here's the demand. Now look what happens. People are gonna want to put their buys right over here, right at this level, right where the market is ranging, right at the base level. People want to buy at the supply and demand zones. This is usually what happens, right? And so what happens is sometimes the market, all right, everybody in the market is thinking the same way, but the institutional money is waiting right over here. This everyone who's trading smart is going to want to buy underneath that demand level. Okay, they're going to want to buy underneath that demand level. Okay, so what you're going to be seeing, right, is the markets come back down to it, probably do a liquidity sweep, and that's where you want to enter in. You know, we mentioned this before. So here's base. Okay, expansion is rally. All right, contraction, expansion is rally. Okay, here's the retracement, mitigation, all right, and the continuation of that trend. Okay, now, all right, here's the retracement, mitigation right over here, rally, base, rally. Okay, and here's how it looks like when the continuation happens on the bearish scenario. All right, you have the drop, base, drop. Okay, you'll see this. All right, and the continuation of that trend. Here's that mitigation, boom, that touch, and then it drops. But remember, smart money is above the resistance areas, okay, and below the support areas, okay, supply and demand. Okay, so the buyers are underneath the demand levels, all right, the sellers are above the supply levels. Okay, so the market is fractal, meaning that everything that happens on a one time frame also occurs on higher or lower time frames. Price patterns like trends, ranges, and reversals look similar whether you're on a 1 minute chart, daily chart, or a monthly chart. Okay, so application of supply and demand. Okay, here's a rally, base rally on a 1 minute. Okay, on a 15 minute, it may look a little different. All right, order blocks, we already went through this. The last buying or selling candle that forms just before a rally. Okay, right before that hike in price, whether it's spiking up or spiking down. All right, it's the last buying or selling candle that forms just before a rally. Okay. All right, single candle that appears right before market makers and institutional money decide to manipulate the market by creating a shift in market structure or driving a drastic trend continuation. All right, they're literally waiting for this. Supply and demand types, reversal, continuation, and flip. All right, so trend reversal base. This is a drop base. This is a drop base rally right over here, and then you got a rally base drop. So in other words, it's just the market coming down, all right, to a demand zone, all right, and then going and then shooting back up, all right, but it's not going to shoot back up unless it retests it, all right, or it mitigates. Okay, here's how it looks like on the bearish scenario right over here. Okay, continuation base indicates that price is more likely to continue in its dominant direction after temporarily pause. All right, we know this. Okay, a flip pattern refers to a specific price pattern that signals a potential shift or flip in a market direction. Think of change of character, right? We're gonna see a couple of different things. All right, it's gonna hit a rejection zone, the flip zone, all right, before you start to see it change that character, before you start to see the market trending in the other direction. All right, so flip patterns, basically, you're gonna see, that when a previous supply demand zone is broken in the opposite direction, causing it to switch its characteristic from supply to demand and vice versa. Basically, a flip zone is when support becomes a resistance, resistance becomes support. You guys know this. So sometimes supply becomes demand, demand becomes supply, and we see that happen in the market again and again. That is a flip pattern, okay? So the markets will retest these areas as well, all right, and cause a flip, okay? So candlestick supply and demand types, the range, the pivots, and the fractals, okay? highlighting a range. All right, so obviously consolidation is basically when the market is ranging. Okay, so in a high level like this, basically a resistance zone, this is where the supply is at. Okay, it's going to drop from this level, come back up, and then drop. Okay, so here's a base. All right, here's a base and a drop. Okay, but it's going to come back up to mitigate, to retest. All right, whatever you want to call it, retouch, and then it's going to deflect. The same thing on a bearish on the bullish scenario. Okay, in this point. All right, here's a pivot scenario. All right, same thing. You're waiting for these touches to happen. Okay, sell to buy. All right, here's basically one concept, right? Sell to buy right here. Basically is an order block, right? But on a demand zone, right? While this is an order block here on a supply zone. Supply resistance, demand support. Okay. All right. So buy to sell, same kind of concept. Okay. People are going to be waiting at these ranges, but really that's where the market is finding some balance, gathering up some liquidity. Most people are going to be waiting for these moves to happen. Okay, fractal supply and demand types, inside bar. Okay, sell to buy, buy to sell wick zones, and wicks. Wicks, to me honestly, wicks are very telling to me. I find a lot more. I find levels a lot more respected when it's wick there as opposed to body closes there. Whether it's a body close open or body, body close or body open. Okay, wicks are very, very telling. I mean, that's why we use Fibonacci's from wick to wick, for example. So on a fractal supply and demand type, okay, here's how it looks like in the inside bar. Right over here, here's a sell to buy situation, a buy to sell situation happening right over here. And here's the wick touches right over here. Candlestick formation, okay. The stronger the price moves away from a zone, the more out of balance supply and demand are to be in that zone. Right, so we see, for example, 3 bearish candles back to back. That's strong. That's a strong deflection. That's a strong, drop right there. Right. This is the strongest form. This is strong too. You have a little bit of a pullback, right? But this is going to be the strongest because this is a sharp drop, right? This is a pretty strong drop too, but this is a weak drop right over here. Okay, because the pullback candles are pretty pretty sizable compared to this scenario right over here. Okay, the duration of price in the supply and demand zone is telling. The less time the price spends at a zone, the more out of balance supply and demand are at that level, indicating a more aggressive entrance by smart money. Okay, the freshness of the base. Each time price mitigates a supply and demand area, it reduces the remaining supply or demand in that zone, weakening its strength. So here, look at this. The drop, base drop right over here, okay? And then you notice every touch to the supply area, okay, the market is narrowing down. You see a little bit of a flag pattern right over here, okay? All right, break of structure versus change of character. We already went through this. Basically, break of structure is basically indicating the continuation of a trend, or a good indication that the trend is continuing. A change of character means that there is a reversal happening, all right, with the trend. ICT and SM concepts, all right? So inner circle trading, smart money concepts, fair value gap, okay? The power of 3, remember, accumulation, manipulation, distribution. I want everyone to anticipate that manipulation before they get into the market, okay? ICT premium and discount, okay? Remember, the bottom half, the bottom part of the 50% is basically discount, and above that is premium, okay? ICT kill zones, all right? So here's basically some windows between sessions where it can overlap and stuff. So this is where you will be able to find a lot of activity, a lot of volatility in the market. There's a lot of smart money at play, there, okay? So ICT fib settings. I mean, you can keep your fib settings as it is. You don't need to, have only these levels. I mean, these are typical levels, right? From 0 to 1 anyway, right? The 50 point, all right, 618, 786, and 1. Okay, that's standard. All right, so which fair value gap is valid? We actually spoke about this before, right? But here's a visualization of it, right? So it has to be a candle going in the opposite direction that closes before that move to the upside, for example. That will determine, okay, this the top of the wick over here is going to be the start of that fair value gap, right? But that's not the same over here, okay? But over here, it has to be the one that's considered, for example. So this is invalid, but this makes it valid, okay? So it has to be the opposing candle, all right, that the top of the wick of the opposing candle or the bottom of the wick of the opposing candle, depending if it's a bullish or bearish scenario, that's going to be the start of that fair value gap. All right, bullish scenario. Okay, again, remember, I want you to always remember this: accumulation, manipulation, distribution. Okay, so here's the takeout. Here's the liquidity sweep right over here. All right, here's the order block. Boom, this is the order block. Okay, this is where a lot of people are buying, selling, and having pending orders at. All right, in the bearish scenario, it's going to be right over here. All right, this is going to be liquidity grab. This wick right here is the liquidity grab. That's the liquidity grab right there. Boom, right? You want to get in right after that happens, okay? Because smart, you want to go with the flow. Go with the smart money flow, okay? So bearish scenario, okay? Yeah, we just basically mentioned this again, all right? Valid order block and invalid order block. So we went through this, okay? Very simple concepts. We already went through it a couple of times, all right? Invalid order block, okay? So in this case, why is it an invalid order block? That's because there is no fair value gap. Look at the wick over here. Look at that right there. So there is no gap, okay? There is no gap between, all right, the opposing closing candle, right, and that second candle after the market starts rallying or after that impulsive move, right? So it has to be that gap there, all right? So peep that. Okay, and must lead to a break of structure or a change of character, right? So think of rally, base rally, drop, base drop. Think of these kind of movements, but along with the breaks of structures and change of characters that you gotta look out for. So in the market, you're gonna look at the charts, and you're gonna be able to identify all kinds of different order blocks, fair value gaps, breaks of structures, change of characters, all that. Okay. You're going to be able to determine all this stuff. And this is important because do you need to know candlestick patterns with this? No, you don't. You can literally just wait for the structure to tell you the story. Like literally just wait for the structures to tell you the story, right? So in this case, here's a major high, right? The market comes over here, all right? Next thing you know, okay, here's that final opposing candle before the market starts to go all the way up, okay? Now look. Break of structure, boom, another major high, test another major high, okay, here's the inducement. A lot of people are going to be taking orders. Oh my God, the market is reversing. Let me get this up, sorry. Break of structure again, all right, then eventually it's going to start to make its moves. Here's the touch, here's a mitigation right over here to this order block, boom, another rally, right, take advantage of that, boom, another rally, take advantage of that. It ain't truly going to be reversing anytime soon unless you can identify a true change of character. So look, here's that touch right there. This is what people are doing right over here. All right, look at this. All right, order blocks and order blocks. Okay, a lot of order blocks are good for a one-time touch and then that's it. Remember, the higher the time frame, the better. Stronger the confirmations. Okay. So 4 major types of entries using order blocks. Okay, look, we could go into so many different topics over here. I obviously borrow these visuals and whatnot to give you that visual, explanation and experience, because some people don't really have it. Some people, they hear the information, but they don't really have the visuals to go along with it. But 4 major types of entries using order blocks. Let me actually, and this is going to be the final one because I know I'm probably over my time. I'm probably way over my time right now. So a couple of different ways to approach it. Okay, in an order block, in a bearish scenario, okay, you want to give it a little bit of a spread, all right, before you decide to enter, a sell. Okay, you want to give it a little bit of a spread before you put your stop loss there, because the liquidity sweep is going to be right, was right over here, so you want to put it above, right? And then you want to be able to trigger, all right, trades within the order block, going in the direction the smart money is going. Okay, here's a wick entry. This is one type of entry. So you can, the candle that forms the order block, You can literally take a wick entry, and that's one way of doing it. Okay, you can take a wick entry. All right, here's another scenario right over here for that wick entry on a sell, right there, for example. Okay, there's another opportunity right there. Okay, another scenario is the body entry. So the close of the body, right, will be the entry zone. Remember, stop loss is going to be above where that liquidity, the peak of the liquidity sweep, all right, of the liquidity sweep right here. Okay, and you know, so here's a body entry, all right. So it's going off of the closing, all right. It's going off of the body of the candle, okay. In this case, here's the other scenario. Another scenario is the entry at the 50% level on the order block. You know, use fibs if you want to measure, you know, the exact 50% entry. But you don't have to do it. You could just, you know, visually tell and just, you know, make sure you put your short position tool in this bearish scenario or bullish position tool on the bullish scenario. Okay. So you go, all right, entries at 50%. All right, make sure you put your stop losses above, you know, the liquidity areas in the bear scenario. Put your stop losses below the liquidity, the peak of the liquidity sweeps in a bullish scenario. Okay, so this is it. All right, we spoke about the body entry. Okay, yes. All right, we went through this. I feel like I'm repeating myself over here. Okay. And that's basically that, y'all. Listen, if there's order blocks stacked on top of order blocks, and it's kind of like consecutive, you know, be careful, you know, because, you know, the market, again, is pretty cutthroat, right? Look out also for, you know, areas that act as support, resistance, or both. Okay, a lot of liquidity sitting around these areas, all right? You have the extreme order block over here. It's probably safer to go, all right, with an extreme order block in a scenario where, you know, it just seems like there's you know, consecutive order blocks, you know, in line. So lots of liquidity sitting, you know, in these channels, in these trend lines, in these support resistance areas, because everybody is thinking with a similar mindset. They really are. Okay. All right. Here's the change of character order block. Right over here. All right, here's the swing high right there. Typical market structure. All right, I'm actually done. I'm actually done. So the eighth wonder of the world is compound interest. Okay, it's the eighth wonder of the world. He who understands it, or she who understands it, earns it. He or she who doesn't understand it pays it. Okay, you know, you guys don't really need the formula of compound interest, but basically you have to understand that you should come up with your own plan to scale your account. For me, what I've discovered is that if I do 5% a session for 50 sessions, I could 10x my account. So whether that's $500 to $5,000, $5,000 to $50,000, or $50,000 to $500,000, all right, it can be done. And what's the difference? There's really no difference when you look at stuff in terms of percentage. There's only a difference when you really synchronize your emotions to the amount of money that you're trading. So in the beginning, like everyone else, you know, I was watching my trades every second. While it was active, I'm over here just going along with the impulses, and I'm driving myself crazy. That's how it was for me almost 10 years ago in 2015. Okay, and now it's different for me. You know, as a forex trader, you know, I trade other forms of trading too. I love trading binary options. That's me. That's my quick way of just trading and getting to the bag. But when I trade Forex, I do trade with the institutional style. This is the style that I was taught by the OGs, right? Unfortunately, they didn't have the impressive visuals that we can find today online, right? But bottom line is there's a lot of money sitting around, okay? And you now know what to look for. Accumulation, manipulation, distribution. Look for that manipulation. You're gonna find this all the time. So hopefully, for those of you that you know saw me teach before, now you kind of know the concept as to why I use the Bollinger Bands a lot in my binary trades, for example, and even when I do Forex on a high time frame. Basically, I wait for another touch, you know. So if the market hits my Bollinger Band, the top of the Bollinger Band, yeah, I'm thinking, okay, I'm gonna go in for a sell. But what I like to do is I like to wait for a spike up. You guys remember that? Remember how I always, for those of you that know me from back then, you remember how I always waited for a spike to happen and then I went against it right after it happened. I went the other way with it right after it happened. So if there was so if the market touched the top of my Bollinger Band, I would wait. And then when I see a spike up and go all the way through my Bollinger Band, it was outside the Bollinger Band, and I finally started to see that the market was correcting itself, I went in with the correction. That's because I was waiting for the manipulation of the market. And I even spoke that in all these sessions that I've been on for all these years. I always used to go in and say, oh, look, the institutions are manipulating the market again. But people didn't really understand what I was saying because they only wanted the rush of the trading that I was doing. But now you're kind of getting the picture. Now we're, we elevated, all right? We're not in that Pee-wee league, type of scenario. Because back then I would just trade, get my bag, and just leave, and everyone was just happy watching me trade. But I'm in a stage right now where I want to show you really where the money is. I want to show you really why there are people that work for the bank, people that trade for the bank that can't sleep at night because they're excited about going to work the next day. I mean, these people are excited. The only difference is they're not able to keep 100% of the capital they win for the institutions they work for. But you can keep 100% of the profits that you make. That's the plus of being a DIY trader. You get to keep the profits. No one else. There's no cuts, right? So, I know I'm now a part of this growing family, now, and I come live on Mondays. But I want you to understand accumulation, manipulation, distribution. Wait for that manipulation and then just go right in, right? Go right in. Listen, you're going to get hurt. You're going to get hurt when you trade. All good. Fund it one more time and go at it again. Most people give up after the third blown account. Newsflash, guys, I blew like over 20 accounts at this point. It's normal, right? Get your numbers up. How about that? Every time you blow an account, that was your deposit to your market school tuition. Okay, look at it like that. And then you start looking at it different, right? You paid for that hard lesson. Now you know what not to do again. And now you're left with the things to do, right? So shout out to Alpha Trading. Shout out to Just Rob. Shout out to Brap. All right, shout out to MPZ Trading. Shout out to all my peoples. And I think I went way over my time. Follow me on Instagram. Just Rob is gonna tell you how you can follow me. I don't, I'm still new here, so I don't know what not to say, at this point. So I'm gonna humbly step aside and Rob can tell you guys how you guys can follow me. If you have any questions pertaining to this, please let me know. But I know I'm over my time, so I'm gonna go. But shoot your questions directly over to me and Rob. Maybe he'll start like a group chat with us or whatever, or just write it in the Alpha Trading.
No, guys. Guys, if you got a couple more minutes, if you guys got any questions, guys, shout out to Nes. Put a fire emoji, put a 1 in the chat for Nes. If you guys enjoyed today's class, he went over a lot of things. You guys are now unable to mute yourselves. If we can be respectful, Nes, you're gonna mute yourself. Well, if you guys got a couple questions, feel free to ask him.
Okay, I'm able to unmute myself again. All right, guys. So yeah, if you have any questions, let me know. Is there going to be a recording of this class? I believe, if I'm not mistaken, this is being recorded by Just Rob and Brap and the squad. I'm not sure. This is not my Zoom, so I don't know. It's probably being recorded. Anyone have any questions? I got you. Tell me right now, and I got you. All right, so I'll wait. In the meantime, I'll just share a couple of final thoughts. So long story short, okay, look out for those manipulation moves. I think it's very important. I know it's easy for us to want to just like jump into a trade and just go in for that suicide dive on a small account, right? But listen, there's more to it than that. And if you don't have a lot of money, I don't want you to be ashamed or nothing like that. Even if you have like, $100, $200 in your account, listen, it's all good. There's two ways you go about this. Either put up more money, so you put up more capital, right? And learn some of these lessons and really feel them, and then feel the euphoria of every win. The other scenario is, you know, get funded even with a little bit of money, and then just work your ass off. Sweat equity. Either you bring in the capital, or you make up for it with sweat equity. Hold on one second. I got Rob calling me. 1 second. Yo, what's up, bro? Oh, oh, your phone died. Yeah, I'm still on here. I'm closing off right now. I got you. All right, appreciate you, bro. You welcome, bro. Peace. Shout out to Rob. He definitely got us in here. So my @ is Nes Vquez. I'm gonna answer questions, by the way. So but here's my Instagram. All right, Nes Vquez. You can find me right there. Okay, ask me whatever questions that you would like. Okay, me personally, guys. I'm a binary trader. But I also trade forex. I like to trade forex based on news, really, and so I find peace in that, because I just put my stop losses and my take profits, and I'm good. I know all the potential outcomes of my trade. Um, Nes Vquez. So at NESVQUEZ, the one with the check. All right, there might be some false accounts there. Don't follow them. Follow the one with the blue check only. Okay. No questions, but thanks for this. I appreciate you, David. Thank you. Joel Costa. I just sent you a follow IG. I appreciate you. If you don't mind following to send you a message, no problem. I got you. I want to know, if I invest 100,000 US dollars, what leverage should I use, and how many lots should I use in gold USD? Well, gold is a momentum based trading asset. It's a momentum based trading asset, so when it moves, it really moves. So at a $100,000 account, you can go with, for example, maybe, because even in a 100,000 account, sometimes 2.5 lots could be freaking insane. So I would say, two full standard lots to be safe, especially if you're just getting going. After a while, you're gonna probably put a substantial amount of lots in it, probably like 5 lots, 10 lots, something like that. But there's levels. Where can you find me? You can find me on Instagram, Nes Vquez, at Nes Vquez. Followed you. I appreciate you, y'all. Yeah. So long story short, there's really a lot to unpack over here. Truly a lot. And see if I could get back in here. Okay. So what we left with this. So since I do have a little bit more time, basically, obviously, you want to rock with, alpha trading. I use all kinds of different brokers. I have different accounts for different reasons. Is either to grow or for particular reasons. But you choose that. I'm more of a binary style broker, and when I do trade forex, it is definitely based on news. Listen, make sure you go through the verification process of alpha trading and whatnot. And easy way to fund it, you can use Bitcoin on your Cash App. I know I'm speaking to a lot of people from the United States, so you have access to Cash App. They make it really easy. Just buy Bitcoin on Cash App, and then fund your alpha trader with that. It's really simple to do it. Get the barcode and all that good stuff, and it's real easy to send your stuff over to alpha trading. So get your Bitcoin and send it over to alpha trading so you can fund that account and be lit. I gotta obviously update my slides because I know this is different, but I trade all kinds of different brokers. Now, let me play this final piece before we leave off, and I promise you it's gonna be like less than 60 seconds. 'Cause I forgot I had this up. Trading can definitely change your life, 100%. Okay, I've been able to do things that I never thought I would do. I've been able to live in places I never thought I would be able to live. I've been able to own a fleet of cars that I never thought I would have. Right? So Don't do this just for the money. Do this for what you could do with the money, right? Do this for the freedom, right? Become your own bank, and it could become a very different ball game for you. So my hope for you is that you trade your ass off and you kill the game. All right. And with that said, ladies and gentlemen, thank you so much. Stay blessed, and I'll see you another time. Peace out. All right, stop the screen share, and we are out. Peace, y'all. Thank you for tuning in.